Welcome to This Explainer. Okay, today we're tackling a massive financial puzzle. We're talking about Applied Optoelectronics, or AAOI for short. And let me tell you, the data behind this company is absolutely fascinating. I mean, seriously, how in the world does a stock shoot up over 900% in a single year while at the exact same time it's bleeding hundreds of millions of dollars? Sounds completely impossible, right? Well, we're going to look under the hood of a stock that is literally defying financial gravity right now. Let's figure out what's fueling this rocket ship and, honestly, what massive risks are lurking just beneath the surface. Let's dive in. Since there's a mountain of data to sift through, here's our roadmap for This Explainer. First, the 900% rocket ship. Second, fueling the fire. Third, the profitability paradox. Fourth, financial health under the hood. And finally, valuation, boom or bubble.
All right, Section 1, the 900% rocket ship.
Let's just start with the sheer magnitude here. The trailing 12-month total return for AAOI is a mind-blowing 950.19%. That is the kind of explosive growth that instantly grabs your attention and dominates the financial headlines. But, a single number never tells the whole story, does it? When you zoom out to look at the historical context, you see some wild volatility. I mean, we're talking massive, brutal crashes, down over 59% in 2018 and crashing another 63% in 2022. But then out of nowhere, an explosive 922% gain in 2023, followed by a year-to-date return of nearly 294%. Talk about a roller coaster. It's just this crazy juxtaposition of severe crashes and unimaginable gains.
Section 2, fueling the fire.
So, what exactly is the engine making investors pour all this capital into such a turbulent stock? Well, the fuel is massive, undeniable top-line growth. The trailing 12-month revenue compound annual growth rate, the CAGR, hit nearly 83%. Look, in the business world, growing your top-line revenue by almost 83% in a single 12-month stretch, that's incredibly rare. It's a huge signal that the demand for whatever AAOI is selling is absolutely surging right now.
And it's not just a random one-off spike, it's a compounding acceleration curve. If you look at a 5-year horizon, top-line growth was a steady, respectable 14%. Then, over a 3-year horizon, it jumped to nearly 27%. And then, in the trailing 12 months, it just went parabolic to that 82.75%. For growth investors, this is exactly what you dream of seeing, a business rapidly scaling up its sales velocity.
Section 3, the profitability paradox. Now, this is where things get really interesting, because we have a huge paradox here. AAOI is growing sales at an unbelievable 82% clip, right? But they are operating with a net profit margin of negative 43.7%. Think about that. For every single dollar of revenue they bring in the door, they're losing over 43 cents. Literally, the faster they grow their sales, the more money they are actually losing. To really grasp the risk here, we've got to cut through all the accounting noise and look at free cash flow. This tracks the physical, actual cash moving in and out of the business.
And wow, the data reveals a massive leak. Over the last 12 months, AAOI has burned through almost $354 million in free cash flow. Guys, that's not some abstract paper loss. That is hundreds of millions of dollars of real physical cash leaving the business just to sustain this rapid revenue growth.
When you add in a net income loss of over $38 million and a negative 7% return on invested capital, it paints a pretty stark picture. The capital they deploy is actively destroying value. It absolutely begs the question, is their current operational model fundamentally sustainable in any way?
Section 4, financial health under the hood.
With cash burn that severe, we're talking over $350 million exiting the business, you're probably wondering how on earth this company hasn't gone totally bankrupt yet. Well, looking under the hood actually shows a surprisingly sturdy safety net. Despite the massive unprofitability, AAOI carries very little debt relative to equity. Their debt-to-equity ratio is just 0.27. Plus, they maintain a healthy current ratio of 2.63 and a quick ratio of 1.91. They actually have highly defensive liquidity metrics to easily cover their short-term obligations. And you know what's really fascinating? That liquidity is actually improving. Their trailing 12-month current ratio is sitting nearly 60% higher than its own 3-year average. So this proves that while they are unprofitably burning cash on the operational side, they've done a really effective job managing their balance sheet. They've made sure they have the liquid assets required to cover their short-term bills. Basically, this strong balance sheet is the runway that allows them to keep flying, even while losing a ton of money.
Section 5,
Valuation, boom or bubble.
Okay, let's pull all this together. We've got explosive top-line growth matched with massive bottom-line cash losses, all stabilized by a solid short-term balance sheet. So how is the broader market pricing this highly complex reality? Well, since AAOI essentially has zero earnings, traditional price-to-earnings ratios are kind of useless here. Instead, we have to look at the price-to-sales ratio to see the premium investors are willing to pay purely for that explosive revenue.
Right now, the stock trades at an incredibly high price-to-sales ratio of 23.77. Just to put that into perspective, that is over 200% higher than its own trailing 12-month average. The market is pricing this stock at an absolute sky-high premium compared to its own historical baseline.
And when you look at the rest of the valuation metrics, it's a sea of red. We're looking at a staggering negative 211 price-to-earnings ratio, an enterprise value to EBITDA ratio of negative 401, and a PEG ratio of negative 2.49. What this mathematical reality makes crystal clear is that investors are completely 100% ignoring current on profitability. They're betting entirely on future potential over present reality. They're paying top dollar today, assuming AAOI is somehow going to magically turn that 82% revenue growth into massive profits tomorrow.
Which leaves us with the ultimate question. You've seen the raw data for yourself. You've seen the explosive 950% returns, the accelerating 82% revenue growth, the solid balance sheet, but you've also seen the massive $354 million cash burn and those sky-high valuations. So, when you weigh all these metrics against each other, you have to decide, is AAOI a calculated, brilliant tech play where revenue will eventually turn into massive profit? Or is it just a fundamentally flawed house of cards waiting to fall? Thanks for tuning into this explainer, and as always, keep questioning the numbers.